Hello viewers, in this video I'm going to be talking to you about some basic forex terminologies. So just hop on and let's get into the video. Number 1, forex account. What is a forex account? A forex account is an account you open with your broker. Now this account allows you to be able to place trades. Now there are usually different types of these accounts. You have the micro account, the mini account, and the standard lot account. Now many brokers actually offer different types of these accounts, and you really need to know the one that is going to be what is going to suit you, because there are some accounts you can't just open depending on, for instance, if you have a small dollar account, you want to open a small dollar account like $100 account, you can't open some certain types of accounts. Or let's say you are even a trader that wants to trade with just like $10, for instance. Trading an account like a standard account is really not going to be favorable for you. So you might want to look for an account that is lower, like maybe a micro account or a mini account. So that is what all these accounts mean, and that's the reason why we have different types of these accounts actually. So number 2 is PEEP. Now number 2, what is PEEP? PEEP is basically the smallest amount of move that a price can make. And what that means is, for instance, let's say we have gold, a metal, and we want to trade gold, and where gold moves from $1,800, which is $1,800, up to $1,801, which is $1,801. Now that small $1 move is what we call a PEEP. Now let's use Euro USD for instance. Now let's say Euro USD moves from 1.0000 to 1.0001. That's 0.0001 increase is what we call a PEEP. So what is a PEEP in this Euro USD case? A PEEP is basically 0.0001. That is the size of a PEEP. Now number 3, ask price. What is ask price? Ask price is basically the lowest price at which you are willing to to buy a particular currency. The lowest price at which you are willing to buy a particular currency. That's basically it. And what is bid price? Bid price is basically the highest price at which you are willing to sell a particular currency. So let's look at this instance of GBP USD. Now you can see two prices here, 1.2749 and 1.2752. Now what is going to be the ask price here, and what is going to be the bid price here? Are you going to guess it? Alright, if you said the ask price is going to be 1.2749, then you're correct, because that is the lowest price in this case. And if you say the bid price is going to be 1.2752, then you're also correct, because that is the highest price in this case. So now if you look at this picture, you can see now that to get the PEEP price of this, to get the PEEP of these two prices, what you need to do is minus this lowest price from the highest price, then you get your amount of pips. And in this case it is just 3 pips. So if this market moves from 1.2752 up to if the market moves up from 1.2749 up to 1.2752, that is going to be 3 pips. So you would have gained 3 pips if you were in this trade, and your profit is going to be equal to 3 pips. Now also you need to know that your spread is also the same thing actually. So the difference between these two prices is also equal to what we call spread, and this is what you need. One of the things you need to look out for when choosing a broker. You need to look out for your spread, the spread the broker is offering. Now you can see in this case now, this spread is very tight. It is 3 pips, and that is very good. You don't want to go for some brokers that are giving you some pips or 50 pips as their spread. No, you're going to lose a lot of money that way. So you need to go for brokers that gives you 3 pips in spread. Now number 5, bear market. What is a bear market? A bear market is basically a market that is trending downwards, or that is moving in the downward direction. And number 6, bull market. What is a bull market? A bull market is basically the opposite of a bear market, meaning a market that is trending upwards or a market that is moving in the upward direction. And if you look at this picture, you can see here, you see where this place where the price, where this place where the market is going up, this is what we call a bull market, and this place where it is coming down, that is what we call a bear market, because the market is going down. Now number 7, let's look at leverage. What is leverage? Leverage is basically the amount of money that your broker is going to borrow you in order for you to have some trading opportunities in the market. So, and the higher the leverage that you get from your broker, the higher the chances you have in the market. So, but also the higher the leverage that you are giving, the higher the possibilities for you to lose money. So it's either way, depending on how good you are or how bad you are as a trader. If you're a bad trader, your high leverage is going to make you lose a lot of money. But if you're a good trader, your high leverage is going to make you win a lot of money. Now to number 8, spread. The spread is the difference between the bid price and the ask price, as I told you in the previous slide. So, and you can see another example here using the Euro USD. So when you minus the highest price from the lowest price from the highest price, that price is what we call a spread. And you can see in this case, you can see it is 2 pips. This one is even tighter than the last one. The last one was 3 pips. This one is 2 pips. So it's even much easier. Now, you need to also know that your brokers do not give a fixed spread. So you're not going to find out that the spread is going to be fixed, but it will be varying from, so for instance, let's say this spread now that is 2 pips, it can be moving between these 2 pips and like 5 pips, 2 pips to 5 pips, like that, depending on the volatility of the market and how fast the market is moving and the time of the day. So all of those things are factors that determines how stable your spread is going to be, or if it's going to be coming either or becoming tighter. So, but it is very good that you go for a broker that just offers you a very tight spread that will not be moving between highest 10 pips. Even 10 pips is a lot. Now let's look at the last terminology here, which is lot size. Now, what is lot size? Now, the higher the lot size you use to place a particular trade, the higher your chances of making more money in that trade. And the higher your lot size that you use in a particular trade, the higher your chances of also losing money if it goes in the wrong direction. There are 4 types of lot sizes that you can use actually. We have standard lots, we have mini lots, we have micro lots, and we have the nano lots. Now, I want you to look at the picture beside. You see in this section here, you see something, gold sell 0.50, and you also see gold sell 1.00. So what this means is, you see that 0.50 you see, that is actually the lot size that this particular trade, and this was a trade that I placed some days ago, and this is the lot size that the trade was placed at, 0.50. And the other one you see is gold sell 1.00. This is the lot size that this particular trade was placed at. So now let me give you an instance, an example. Let's say you placed a trade and you used a lot size of 0.01 lot size, and at the end of that trade you made $10. Now that same trade, if you had used a 0.10 lot size, what you would make would not be $10 but would be $100. And that particular same trade, if you used a 1.00 lot size, what that means is that instead of $100 you would have made $1,000. So you see now that lot size actually increases your chances of making more money in the market. But mind you, if it goes in the wrong direction, it means it also increases the chances of how much you can lose in the market, which is the reason why it's very important that you learn about Forex. Because when you learn about it, you are going to know how to just place the right trade, and which is going to be able to make you to become a profitable trader in the Forex market, and will reduce the amount of losses you will be getting. Now let's look at the different charts used in Forex trading. We have what we call the line chart. And if you look at this picture, you can see this line representation here, this line representation. So these lines is what we call, this is what we call a line chart. And this line chart is plotted using the closing price of the day if it's a daily chart, or plotting the closing price of a 5 minutes if it is a 5 minute chart. So now let's look at the next one, which is the bar chart. Now you see the bar chart here. It looks like a candlestick chart, but it's not a candlestick chart. Let me zoom in so you can see this. Now if you look at this individual bar, you can see it's a straight line. You can see it's a straight line, and then you are seeing some things that on it that looks like spike on either side. Now on this left side, this spike you see on this left side is what we call the for this green candle, this is the opening price, and this other spike you see on the right here or at the top, that is what we call the closing price of the day. While this price you see here, the very extended, that's what we call the lowest price of this candle, of this bar, I beg your pardon, and this highest point here is the highest price of this bar. Now let's look at the candlestick chart. Now this is the most widely used one. Every trader uses this one. Majority of the traders that trade forex uses this because it gives you a better representation of the forex market than any of the other two. So this is the one I'll be advising you to use because it gives you a better representation. So you can see it looks like a candle with some wicks on it, only that some of the candles are going to be having wick on the top and bottom. Some don't have wicks on their top and bottom, but just on their top, or some just on their bottom. And I'll be telling you how to interpret this in the coming videos to come, when I'm telling you about the strategies that you can use to trade your forex market to be profitable in the forex market. Alright, now let's look at some basic forex trading strategies. Now these are the different types of traders that we have. Now a scalper is somebody, now this is called a scalp trade. A scalper is somebody that just goes into the market and comes in as quick as possible, goes in and comes out as quick as possible. Now this can happen in space of seconds or minutes, in fact. While day traders, these are traders that actually hold their positions for minutes to even hours sometimes. And while a swing trader is a trader that actually holds position for days and sometimes even weeks. Now there's one more type of trader that is not listed here, that I didn't list here, and that is a position trader. A position trader can hold a position for weeks and even months before they close their particular trade. So meaning a trade that a scalper is going to open and close in the next few seconds or minutes, a position trader can hold that same trade for 2 weeks, for 3 weeks, for 4 months, depending on how long he has predicted that move is going to take place for. So these are like the basic trading strategies that traders use, and I just listed some of for you here now. So that is the end of today's video. Thank you for watching. If you found this video helpful, like the video, hit the subscribe button and turn on your notifications so that when I release a new video, you'll be the first set of people that's going to be notified that I have released a video. So thank you very much. See you in the next video. Bye bye.